This is Declan Spring, and thanks for listening to the Mostly Real Estate podcast. My guest today is Kerri Naslund-Monday, a friend of the podcast. Kerri has been on the podcast twice before. Almost a year ago to the day, on May 30th, I dropped episode 56, which was a conversation with Kerri all about the condo market. And what we're doing today is kind of a one-year check-in about the current state of the condo market. It's not good, but we want to talk about it. And if you'd like to get to know Kerri even better, you could go back to our March 14th, 2025, episode number 47. And that's kind of a deeper dive into Kerri's life and career in real estate, which is really a good listen, and you can get to know her better. So today's conversation actually was recorded a couple of weeks ago, and May is a busy month in real estate here in the Inner East Space. It took me a little while to get the podcast edited, but the thing is, I'm kind of glad it took me a couple of weeks to edit the podcast, because a couple of things came to my attention in the last couple of weeks that I could bring up here, fortunately. One of those items is an SF Chronicle article that was published on May 10th, 2026. And the headline was, "Oakland home values continue to fall at one of the fastest rates in the nation." Now, this article got a lot of pushback from the local real estate community, and for good reason. It was kind of irresponsible reporting. A major part of the pushback was that the Zillow data used in the story blended condos and townhomes and single-family homes into one typical home value metric for Oakland. And that matters a lot because in Oakland, the condo market has been dramatically weaker than the detached single-family market. The Chronicle article, relying on Zillow's data, the typical home value index, reported an inflation-adjusted 11.4% decline year over year. But Oakland is one of the most segmented markets in the Bay Area. A downtown condo in 94612 and a renovated Crocker Highlands or Rockridge house are just not moving in tandem right now. So I'll put a link to that Chronicle article in the show notes. Take a look out for it. And I guess the one-line takeaway there is that the article flattened a highly fragmented market into one very alarming number. And condos were a major reason the aggregate statistics looked so severe. And the other item that I noticed and that was making the rounds in the past couple of weeks since Kerri and I chatted is a YouTube video from the Property Ledger. The Property Ledger specializes in releasing all kinds of videos about real estate nationwide. And the Property Ledger had a pretty cool video, actually. I think they released it in March. The title is "Why Oakland Condo Prices Just Hit Rock Bottom in 2026, and they write down 31%. They don't tell you in the title down 31% since when. But anyway, they do answer that question in the video. I think it's a good video. It's really a kind of good education in what to look out for when you're looking at various HOA complexes. Now, the problem with the video, and by the way, I'm going to put a link to this particular video in the show notes as well from the Property Ledger. But the problem with it is that, similar to the SF Chronicle article, a lot of the coverage around the Oakland condo market feels a little too alarmist for me. Yes, the tide is still going out in many parts of the condo market, and some complexes absolutely deserve scrutiny. But a good realtor will tell you that when the tide goes out, not all the boats are bad boats. There are still solid opportunities in well-run, financially healthy complexes with strong reserves, manageable insurance situations, and realistic HOA governance. So the challenge is that buyers need to know where and how to look. Oakland, Berkeley, Some complexes are struggling badly. Others are quietly offering some of the best long-term value opportunities we've seen in years. And so now I bring you my conversation with Kerri Naslund-Monday. And by the way, if you like the conversation, if you like my podcast, please do subscribe, like, on whatever platform you're listening. Please share it with somebody in the real estate community, or indeed, please share it with anybody who might find value in these conversations. I am here with Kerri Naslund-Monday again, like a year later, after we had a long conversation last year about the condo market in the Inner East Bay. And it wasn't doing great last year, Kerri. And so kind of wanted to revisit, how is the condo market performing a year later? So thank you so much for coming back.
No problem. Glad to be here, Declan.
Yeah.
Yes.
Oh, I really appreciate your expertise in this. Now, a year ago, we talked about these 4 gut punches to the condo market coming out of COVID. And it was, I don't know about you, and we'll get into it, but I kind of had a sense almost we were probably going to see the bottom within a year of that conversation. I really kind of was hopeful that we would. And there wouldn't be another gut punch, but there seems to have been another gut punch. And so it's affecting a lot of things. But let's talk about it. Let's talk about the 4, just a quick recap of the 4 gut punches that we discussed last year and what had created these challenging times for condos in the Inner East Bay and probably in many places. And then we'll kind of go through them and see if any of those have faded. We talked last year about how COVID, we were still reeling from the effects of COVID on the condo market, right? You know, just broadly speaking, the condo market has not improved. It unfortunately, I had really hoped a year later, you and I would be sitting here saying, oh, there's light at the end of the tunnel, things are improving, but it hasn't. So let's just get that out of the way.
Right.
The condo market has not improved, and it's very, very hard going. So I don't know if we've hit the bottom. I don't know if we have, but let's just go over the four things.
Right.
So we came out of we went into COVID and came out of COVID, and it had a detrimental effect on the condo market, right?
Totally. And I don't feel like the reasons why people were rejecting condos at the time are relevant today. Thank goodness COVID is not a daily conversation, with exception of indicating a time period we all went through, but it's not a consideration now for as far as where you want to live, how you want to live.
Condos had lost popularity because people wanted outdoor space. They didn't want shared amenities couldn't be used, et cetera, et cetera. Those were the challenges with COVID.
Correct.
It's just you're paying HOA dues for what? I can't even use my pool, or I can't go out. Okay. Well, yeah, I agree with you on that one. So those considerations are no longer there. Then we had talked about, interest rates, had a major impact on the market everywhere. That huge, especially 2022, where we saw rates from springtime at 3% go in the fall to 8%.
Right.
Right. And
more than doubled.
Yeah. Do you feel like at least interest rates, or people's sense of where interest rates are, people have kind of normalized to where we are?
I feel like they've become numb to it, whereas before it was hot topic. Oh, where are rates today?
Yeah.
Everyone's refreshing their apps just to see where they might fall. And now it's kind of become a thing that you tell me when I need to pay attention, because I'm not going to hyperfixate on this anymore, because it just feels like this is our new normal.
Right.
Yeah.
That's well put. Yeah. There's so many things I feel like that people need to keep their eye on these days, because there's just, particularly with this administration, the news cycles are just bizarre.
Right.
So you're right. Okay. I like how you put that. That's pretty cool. The other of the 4 gut punches, the third one we talked about, and this was legitimate, and I'm curious to get your thoughts on this. We had this SB 326, the state assembly bill, that impacted homeowners associations in that they needed to inspect all of their elevated balconies and that kind of thing, which led to many HOAs recognizing that there was damage that needed to get repaired, and there was a push on HOA dues, and even a lot of realtors didn't know what was going on with SB.
Special assessments.
Yeah. How are things now with SB 326? Do you think it's the market's sort of priced it in, people are understanding it?
So what I'm seeing with our listings and also with the buyers that we have that are interested in condos is this is the conversation. At our open houses, you know how for single family homes, open houses, the general public comes in and asks if the sewer lateral is complete, or if you're in Oakland, if the sidewalk has been looked at yet.
Right.
Well, in condos, the question, are you SB 326 compliant, is a normal part of the open house conversation or the phone calls you get on your listings every day. So I think we're still really in the thick of it as far as that being one of the pieces of the pie when a buyer is deciding whether they're going to pursue even looking further into this complex.
Yeah.
And the follow-up questions to that are, if it's not compliant, is there a compliance plan? Has a special assessment happened? Is there a special assessment on the way? And or any HOA due increases, which all factors into the affordability equation.
Yeah.
And I think that at this point, most balconies have been inspected. Not all have been brought up to standard. And so that's where that compliance plan comes into place. But even just earlier, I was looking at condos for one of my clients, and I was looking at 7 different complexes. And out of the 7, there was one that was not compliant and had yet to issue a special assessment. And my client's reaction was, forget about that one.
Yeah.
We're going to go look at the other one. So it's still part of the conversation, although people are working through it.
Can I ask you, just jump in, because I have a question. I've seen this. Maybe I want to know if it's a pattern that you're seeing. When I have run across condo complexes that are like behind in their diligence in even getting the inspection done, they're usually smaller, fewer units where it's like managed by the folks, there's no
self-managed.
That's what I've seen this year.
Yep.
And then when you have a greater number, usually more than 12 units, and now you're an HOA management territory, things generally seem to be a little more organized. Do you see that?
I think that tracks with not just balconies, with maintenance in general and or big decisions to be made about the building. Self-managed trends on, waiting until we actually really need it, rather than being proactive.
Right.
So,
Okay. I love that you pointed out buyers are actually bringing this question to open houses. That really says a lot about.
That means our agent pool, our peers are educating our clients properly, and that's refreshing.
That's really, really great. The other thing that comes up that's funny though is People are often surprised by the average cost for HOA dues these days. I find that people who are, looking at a condo for the first time will be surprised that we're averaging $600 or whatever.
Right. That used to be on the high end pre-COVID.
Right. And now it's like more normal. It's kind of shocking to people. And then when they turn around, this goes back to that aspect of, self-managed or managed, properly managed by a bigger company. When they do identify that condo where the dues are in the 300s, I'll usually say, let's take a look at the reserves, because that always troubles. I'm like, I don't know, low dues are indicative. Yeah, they feel good short term, but they're indicative of a greater.
Right.
Do you see that?
It's kind of kicking the can down the road.
Yeah. Or we just take care of things as they come up,
Right.
Okay, well,
exactly. But there's no money earmarked for those situations. So then it becomes kind of home ownership style surprises rather than condo ownership where, the money is being saved for exactly that.
Now, the other thing, and it was a major factor, in the market entirely across the nation for every kind of properties. Insurance, right?
Right.
The insurance market is still tough going, and I always tell a client of mine, that put it this way: since the 90s, we've had 3 contingencies in the contract. And all of a sudden, a couple of years ago, there was a 4th one brought in for insurance. That speaks volumes around, how momentous that was. We now need a contingency for this. But overall, we know it had a huge impact between SB 326 and insurance. There was a real push on HOA dues between those two in particular, right?
Correct. Not only that, but lendability as well, because a lot of these complexes were pooling their insurance plans, their master policies, and Fannie and Freddie don't like that. So now you're limiting the audience to those who can get conventional financing that isn't Freddie Fannie based. And so now when you reduce your audience, the less attention that you're getting, the less you're going to sell for. Right. So that is a huge factor, as well as, can I get this financed with the loan product that suits my needs the best?
Right.
And if the answer is no to a lot of those because of the way the insurance is being held, then that's a preventative or a non-starter for a lot of buyers as well.
Right. So a contraction in the buyer pool is not a good thing.
Yeah.
And so all of these, so it sounds like the insurance thing, where are we at? What did you were telling me before we turned on the mics, that you were happy to see State Farm are writing again?
Yes, State Farm's writing policy again, which means, because they were one of the first to pull out of California altogether. So for them to be writing again means that we hopefully, fingers crossed, are going in a direction where the major carriers are going to consider writing new policy in California again. And once you get those major carriers back in, then hopefully we'll see a reduction in premiums, hopefully. And will we see that translate into lower HOA fees? That's hard to say. We never really see HOAs go down. We see them go up all the time, but going down is another story. But we can hope that maybe.
Yeah, I wouldn't bet on it, but I like the optimism of it. As long as they don't have to continue going up, and they can maybe take a couple of maybe 3 years break from increasing the dues, that would be the win there, I think.
Well, and then not having a pool policy, which is preventative to a lot of lending products.
Right.
Yeah.
Right. Yes, indeed. So there's some glimmers of hope in there for some of these 4 punches receding a little bit. Things sound to have improved somewhat, but we're still in a condo market, at least in the Inner East Bay, where I don't think we've reached the bottom yet. Now,
right.
Yeah.
We were talking a little bit about distressed properties in general prior to recording, and I think it's worthy to say that right now in Alameda, Contra Costa County as a whole, we are seeing around 5% of our condo market in that distressed status. That means foreclosure, short sale, territory, whereas in comparison, our single family homes are like less than 1%, not even a consideration. Yeah. And so that's also a big deal as well. I personally, our team, we do short sales, and a majority of the short sale inventory that we're holding right now are condos. Yeah.
Wow, it's amazing, isn't it? 5%.
Yeah.
There's just something really fundamentally hard about the condo market nowadays that almost doesn't even make any common sense, because that idea that once, 10 years ago was fairly normal, was I can't afford a house, I'll look at condos. Mm-hmm. It seems to just be absent from the market. People just don't want to talk about the condo alternative to renting. Those conversations don't seem to be coming back. And that's what I was hopeful a year after last year's conversation, we'd be once again able to say, hey, people are willing to look at the condo market again to get into a neighborhood.
And I feel like that hope actually was there at the beginning of the year.
Okay.
At the beginning of the year, I'm pretty sure you felt the same. The phone was ringing in a different way. The buyers were coming back with optimism.
Yeah.
Our lender friends were talking highly about how a lot of applications were coming in and mortgage starts were happening again.
Yeah.
And so all of us were feeling that we're climbing out of this. Hooray. And that absolutely would affect the condo market because affordability is such a huge piece to that.
Yeah.
And then what happened?
And then what happened? Well, we decided to go and bomb in Iran. And because it was, that there was a great sense of optimism about many, many things, but definitely real estate. There was a sense of, okay, it's been several hard and weird years post-COVID, and let's get back to something reasonably normal. Let's get back to a market where there's some hope, and rates are a huge part of it. And we hit, I remember it well. It was just maybe 2 weeks prior to the bombs going into Iran that we hit a 5.9. And our lender friends were delighted to find people swarming in looking for refis, right?
Right.
And that hadn't happened. And then within, I think, 3 weeks of that, we were back up to 6.6. We went to 6.6.
Yes.
And now
and
we're
then
at
consumer
about 6.
confidence was just ugh, again. No one wants to spend money. They sit on their wallets when they're not feeling great about things.
What I thought was really odd was we had this other dynamic in the market in general in the East Bay where we basically started the year 30% below last year's inventory, just for single family homes.
Yep.
And we've continued. That's been a feature of the market. It wasn't just a bug early in the year. It's been a durable feature of the market up to this point. We're still 30% in general behind on last year's inventory, which wasn't great either. It's not very low volume years last year, this year.
Right.
And I had thought, well, this lower inventory and lower rates, will bring people back into the condo market.
Yeah.
But it all went kind of awry.
It really did.
Yeah.
And unfortunately, I'm not seeing anything that's going to pull us out of that. I mean, yes, the war could end for real. I don't know. I think they've called an end to the war about 5 times already, and it was just smoke and mirrors. But I really believe that we're going to have to wait for the midterms to get that consumer confidence back to the point that people want to spend money again. People want to make big moves, whether it's moving up or moving down. And then, of course, there's always the affordability financial part to that, which would greatly be improved with an end to the war because there's wartime inflation that's affecting everything at the moment. And that trickles down into our mortgage interest rates.
Yeah. We had so let's call the Iran war this year's gut punch, right? Because it really threw off any
Right. We lost COVID, now we've got the war.
Yeah. So it really capsized any hope that the condo market was going to see a recovery. You and I were both interested in, everybody talks about the canary in the coal mine, which is San Francisco. What's happening in San Francisco?
So San Francisco's coming back.
And the condo market there has even recovered to some degree. And that was beginning in about September last year. We were starting to see that. And the San Francisco market to this day is just wildly different than it was prior to middle of last year, right? So
due to speculatively AI, right?
Yeah, absolutely, 100%. And this was another reason why I thought our spring market for condos, we were going to finally see, we hit the bottom. I really thought March actually was going to be the bottom. If you didn't get into the condo market by March 2026, you would probably look back and say, I wish I'd. And I know that the AI money is definitely, we're definitely seeing people move in single family homes, especially in walkable areas, as you know. I mean, things are nuts right now in the inner East Bay.
Right.
It's very hot and cold. It's a very select area.
Yes.
You know, and a select type of house, and you know, it's not affecting the, you know, the outer East Bay. I don't think is having the same.
Yeah, and it's hard to say because we have to think of who the audience is that is receiving the AI money. Are those your younger age tech bros, or are they the actual middle-aged families or larger than condo living style makeups that I don't know if that by itself is going to directly affect the condo market out here. San Francisco for sure because proximity, but the folks that are willing to commute if they need to, I'm not sure that those are exactly our condo demographic either.
Yeah, I don't. Yeah. I think that, and I think that points to what the problem is. The condo market will only hit the bottom of the market when it's low enough that it becomes the starter home or starter property again, and it's just having a hard time finding its way there. Let's talk about some of these numbers that are really interesting to me, because I think what's not selling is almost more relevant to what is selling. Right? So you had some fairly interesting numbers for me, and this is really where the information is. Go through some of that, the rates of cancellation and that kind of thing.
So I took a look at all of Alameda and Contra Costa counties, and currently we have active condo listings at 1,040 units in supply at the moment. Okay. Of those, 19 are REO short sales or auction, and then another 32 of them are pending in that same status, because we all know those short sales are not short.
Right, right.
So that's where we get our 5% of distressed property from.
Okay.
In the last 6 months, so remember, we have 1,040 active, but in the last 6 months, we've had 901 go expired or canceled.
Wow.
So that's 50-50. Like, half of our condo inventory has been expiring.
Right.
And then there's another 1,104 that sold, but that's a lot. That's a huge percentage. That is not normal.
So you 50% expiration or cancellation rate. Yeah. And I'm always mindful to tell people, I do data on a Sunday and I have a Substack. And I always tell people to look at the days on market, you know, because days on market has been kind of keeping somewhere in basically at about 80 days for many, many months, probably a year. And I always point out to people in the Substack, the reason that it stays there is because, you know, there's a lot of 3-month contracts out there.
Right.
And so things hit 90 days, they're gone. And so, you know, if you had longer contracts, you'd have longer days on market. It's just they disappear from the market.
And then, of course, there's the ones that pull to reset. In those 5 to 7 units that I was looking at earlier for a client, there were 3 of them that had been on and off the market several times for the last 2 years.
Wow.
Yeah.
Wow.
But they're only showing, 40 days on market.
Yeah.
So I don't think days on market are a perfect science for condos right now. I think actually if we were to take a look at the total days on market for each unit, but nobody has time for that. So, but I think that we would see a even more bleak picture of what's going on there. Oh. These are a lot of sellers that are very frustrated.
Very frustrated. So the broad strokes are almost 50% coming off the market, either expiring or canceling. And then, I just looked at March numbers in the Inner East Bay. I wanted to just see what has sold. And I only looked at 2 bedrooms, right?
Yep.
I didn't look at 3 bedrooms, didn't look at 1 bedrooms. They can be difficult too because, you get lofts and weird things in there. But I just looked at 2-bedroom sales in Oakland and Richmond and Berkeley over the just for all of March. And in 2025, the average sales price was $622,000. And in 2026, the average Sales price was $631,000. So it went up very, very slightly, but actually that was only in Richmond. Oakland and Berkeley condo sales are a little bit lower in March 2026 than they were in March 2025. And when you look at Richmond, the sample size, there was only 5 that sold. You know, so like the ones that sell, they've got something special generally, because, you know, there's another 50 that just aren't moving, right?
Right.
You know, so looking at the sale, so when I find, like, if I'm sitting with somebody who wants to list a condo and we just look at the sold property, and I know their condo isn't comparable, doesn't have the special feature or whatever, like, it's a difficult conversation, because the sold property is relevant, but the cancellations are even more relevant. Like, what didn't sell is actually more valuable to understand than what did sell.
Absolutely. Because what I am seeing, the ones that are selling, that are giving us the stats, the ones that are selling are top floor units. Those ones have the lower days on market.
Right.
Views.
Right.
If there's a view, it will sell.
Right.
With lower days on market.
Yes.
And then any kind of extra amenities, like more than one bath.
Right. Yeah. Having the second bathroom.
But I
really
mean,
helps.
the top floor is key.
I agree.
Yeah.
I mean, I had a condo listing last year. It was a hard road because, you know, we watched a couple of units on the top floor with, San Francisco views sell, and they were smaller units, and they sold super fast, and we just didn't have the view, and we weren't top floor. We had somebody upstairs and below us, and the amount below those that we sold, it was really tough for my client.
Yeah,
it was just like chasing the market down. And it was just staggering to me, you know. So absolutely. So like looking at what sold, that's fine in the single family home market in certain areas. But if you're not looking or dealing responsibly with cancellation rates and what didn't sell and all of that stuff in the condo market, your head's
you're
in the
missing
sand.
half of the conversation.
You're missing the most important
75,
part.
yeah.
You're missing the most important part of the conversation. So, but I just see these amazing opportunities that I know are going to stand the test of the next 10 years.
Exactly that. If your buyer is a 10-year or longer buyer, then now's their time.
Yeah.
If they ever wanted to get a good deal, our price points have gone backwards an entire decade.
That's right. We talked last year about how condos are a time machine.
Yes.
And they've gone way back. Sure, you got to price in the difference in HOA dues.
It's still the same.
Yeah, it's still the same.
And we have not climbed out of that. You pulled that with your March numbers. That they have not moved. So we are still at that 10 years ago price point, and it will change. That's the one thing with real estate is it goes up and it goes down, but over time it goes up.
Yeah. The 10-year buyer, as you said.
Yeah.
It really is like, it's one of those moments in the market. Now it's dragging, you know, they say the bottom of the trough. It feels like you know, what these numbers from March 2025, March 2026 tell me is that we're just dragging along the bottom of the trough. We don't seem to have gotten worse.
Right.
Generally speaking, it's just, we're just dragging along the bottom of the trough. It's more of like a bathtub than a V. You know what I mean? It's just like, we're trolling along the bottom of the bathtub here. But at a certain point, you know, things will rise. For those people who want something that they can be really proud of 5 years from now, it's hard to argue that the condo market isn't at that point.
Right.
You know, I really think that's true, but it's hard to inspire that confidence in people.
If we look at San Francisco, they've been inspiration to our shifting market in the past with COVID, they came out first. Yeah. With the Great Recession, they came out first. So the glimmer of hope is there that they're coming out. We also have other triggers we can look for that we know that when and if they happen, it will change the landscape for condos, which is interest rates.
Yeah.
when that'll happen. All of our crystal balls are broken, but there's still hope, right?
Yeah.
And then Declan, you and I were talking about how the National Association of Realtors, and I know this is really broad and like not as granular as we like to stay on this podcast, but I think it's relevant. The National Association of Realtors is lobbying right now to get the capital gains deduction increased because it has remained at that $250,000 per person, partner on the deed for 30 years, unchanged.
Right.
And what has changed in the 30 years?
Right.
Dramatic increase in property values.
Right.
So they are lobbying to get that pushed up. And I think that the perfect audience could be our move down buyers.
Right.
And so if the capital gains deduction gets moved up, that could trigger a lot of movement from our older folks who are looking for a little more simple living.
Yeah, I had a dream last night that rates went below 6% and capital gains exemption went up to $1 million. And it was the most glorious dream I've ever had. But those things could happen.
They could.
They could happen. Just speaking of that segment of people who maybe bought a home 30 years ago for $200,000 and now have an under $1.8 million home, and
right.
They want this exemption to be increased, and it's fair. It should get increased. It's really interesting in our market here how those people are selling houses coming down from the hills, and they're the ones who are putting pressure into the homes down in more walkable areas.
Yes.
Right? Because we this is an amazing thing that we're seeing. So you're getting people in their 40s coming from the city or locally even competing with people in their mid 60s to their mid 80s for the same houses in the walkable areas.
And both of them have cash.
And they all have cash. So that's an amazing, it's an amazing market there. But to your point though, for all its weirdness, this is probably a good administration for things like increasing, capital gains exemption. I think, this is an administration where I could see that happening. I mean, 5 bad things will happen for one good thing, but you know what I mean?
Yeah.
And so that is relevant. Getting back to just condos themselves, like if you had a seller or a buyer sitting in front of you today, how different is your advice compared to a year ago?
Yeah, so I think the advice is still the same. You have to try. Because you are in competition with a lot of other units that are just sitting out there. So you've got to do something to stand out from the crowd. Mm-hmm. And I think that, last year I had a lot of confidence surrounding what we were talking about. But this year that confidence has grown because it hasn't really changed too much.
Okay.
And there are some sellers that are unreasonably stuck to some idea of how it could be or should be. And my best way of dealing with those folks is by just telling them the truth and being honest with them that unfortunately this is not the market for that. Mm-hmm. Sadly, that has lost me some business, but they come back over time too because the other agents that are telling them what they want to hear or sugarcoating the actuality of where we are at with this market, those are those expirations.
Yeah.
A lot of them, not all of them.
Yes.
Yeah.
I feel like a growing number of more seasoned agents are just saying, I'm not doing condos.
Right. Same as when they when they said, no, I'm not going to do those short sales back in 2008. Yeah. So our team has been taking those on with strings attached.
Yes.
We have to have a reasonable seller who is listening, coachable, understands that this is we're not going to perform a magic trick here.
Yeah.
And they have to work with us in order to get to the finish line. And unfortunately, that can have some, good days and bad days. And those bad days are pretty bad, but the good days are really good when we get there eventually.
Well, you're eternally optimistic.
Yeah.
I do follow you on Instagram, and every day there's something bright and cheerful. and, a reminder to look the proper direction and remain hopeful. So I always appreciate that. I mentioned it to you before.
Yeah.
There's always I always click on a Kerri Naslund-Monday story because it's always something uplifting, and, it's just a reminder to be grateful. So
yes.
I love that. Are you seeing more people turn to another agent who perhaps promised something that you felt was undeliverable?
Yes. And you had mentioned the more seasoned agents are the ones that are not looking for this type of business.
Yeah.
Unfortunately, the folks that are making the promises that are undeliverable are newer and
right.
Might not know better.
Is there anything else about the condo market a year past our last interview that you want to discuss or bring up? What am I missing?
So actually, there is one thing, and we didn't talk about this pre-recording. Fannie and Freddie have changed their guidelines.
Yes,
and
I know what you're talking about.
That's within like the last 3 weeks.
Okay,
and so condo complexes that you could confidently before say yes, this you can get conventional financing on this, no problem.
Yeah.
That's no longer the case. And so we are waiting for that one first property to get finished on each complex because they're having to relook at every single complex. It's a whole brand new game because the ones that were certified, it's usually like a 3 or a 5 year certification when Fannie and Freddie looks at them.
Yeah.
Everyone's at zero. It's a brand new start over game. Wow. Because some of the changes that they made are actually in favor of our current landscape. Like the pooled insurance is less of an issue than it was 3 weeks ago.
Okay.
Which is good.
That's good.
But reserves, the minimal reserves has gone up. And so that could be problematic, and we'll watch that to see. It hasn't gone up dramatically, but it's gone up, and that could mean that some of these condo complexes are they don't have enough reserves anymore, and they're going to have to do something about that.
Percent funded in the inner East Bay tends not to be great anyway. I mean, oftentimes I'm talking to people and I'm like, 30 to 40% is not unusual. In fact, that's okay.
Right.
Yeah.
I think that everyone here is going to have to talk with their lender of choice about this to see, because there is a whole sheet of rule changes that have gone down, and I just haven't put them to memory. I just know that.
Yeah, it's very fresh. I mean, 3 weeks, right?
Yeah.
Very fresh.
Exactly.
So I get that.
I think the one other thing that we maybe didn't discuss is the how sales are going when they're vacant versus owner occupied versus tenant occupied.
Yes.
And currently, unfortunately, I looked up before this, out of that last 6 months where there was 1,104 sales, only 20 sold tenant occupied.
Wow.
That's like non-existent. That means nothing's selling. Like tenant occupied units just are not selling.
Right.
Wow. So that is one thing that for our audience to know is if it's tenant occupied, you've got to find some other solutions. Putting it on the market is just going to ruin your relationship with your tenant and make things harder. So possibly looking into something else that will help your situation or reason why you are looking to sell it to the tenant, right?
Yeah. If you can make that match happen, that's a great idea.
Yeah. Find out if your loan is assumable. Sometimes they are. It's very rare that they are, but find out.
Yeah.
See if the tenant can take it on. A lot of times you can find a win there.
Yeah.
So that's just another piece there. The owner occupied versus vacant. Actually not too much different unless the owner-occupied ones live sloppily. But again, that goes back to if you're going to put a condo on the market, you have to try. Yeah. So vacant and staged always will perform better. Virtual staging is nonsense. It's confusing for buyers. They see the pictures and try and figure out why it looks funny. Their brain doesn't like it. Subconsciously, they say no.
It's a letdown. So when we're dealing with a market like this, where 5% of the market is distressed property, I know that you and I have talked before about how you worked on having your own auction platform.
Yeah.
And so, that probably, I don't know, that might have sat idle for a while, but it seems relevant to our current market that you could bring that back into play to create a market. Am I on the right track?
Exactly that. Yes, Declan. So one of the things that our team is doing differently than a lot of, than most out there in order to create an audience for these condos that are sitting stale is using the online bidding platform to get eyes, get bodies in the unit, because sometimes it's about feeling the complex, getting there, finding out that, hey, this is great. How come I never knew about this before? Seeing the views for themselves, if there are any, finding out that the neighbors upstairs actually are very quiet. So a lot of it is getting people in the door, and our online bidding platform has been very successful at reducing our days on market. So you were saying you were seeing average days on market largely sitting around that 80-day mark. And we've been able to shorten that runway, not only with our distressed condos, but our traditional condos as well. And if after we've had, sometimes 30, 40 showings and no offers are presenting themselves, then we get to have that conversation, around that 2.5, 3 week mark, rather than the 90-day mark. And so creating an environment where we're saving our sellers some money on that staging money. We're getting them to the place that, they were trying to decide, should I put another renter in here, or am I going to sell? Well, let us, give us that 2.5 weeks. Yeah. And then at least you tried. Right. Because if we're getting, if there's only, 100 people out there looking for a condo in your area, and we're getting 80 of them to come through your door, and none of them are saying yes to the price that is going to make sense for your sale, right? Then yes, the answer becomes put a tenant in it or find a different solution, move back in. I'm not sure, depending on what their personal situation is. But our online bidding platform has been an excellent tool with this very difficult market.
Yeah, well, and kudos to you, because you built that platform yourself, and you're proud of it, and having the opportunity to see it work to benefit your clients is that's good. That's a good thing. Do you take referrals from agents who just don't want to handle condos?
Absolutely.
Well, we should go over your contact details, which of course will be in the show notes.
Yes.
But, if people have a condo and they're just not up for the difficult conversations, they don't have a platform like you have for doing an auction or that kind of thing, let's remind people of your contact info.
Yeah. So it's Kerri, Kerri, at Monday Team Agents. That's agents with an S.com. And you can always reach out to me, phone call, text message, 510-409-4966. And let's have a conversation about your client and whether they'd be a good fit. And again, I'm not going to tell them that something is viable if it's not. And they will thank you for putting them in position to have a real conversation, rather than having to, go on the internet, hope that the person they found that they don't have a relationship with is telling them the truth. Instead, you're making that introduction. You know that I will be there with integrity, and our team is currently servicing, several condos, several short sales, and we're able to have the difficult conversations coming from a place of understanding and finding solutions.
Well, Kerri, thank you so much for taking time to stop by and have this important conversation. And as we both said, hopefully next year when you're sitting here again, we're high-fiving, and I'm
going to light a candle for that one. Yeah. Okay. Thank you, Declan. Appreciate spending time with you. As usual, you are so easy to talk with.
Kerri, take care of yourself.
You too.
The This episode of the podcast was edited by me, with original music by Chuck Lindo, graphics by Lisa Mazer. The podcast is brought to you by the Home Factor Realtors, thehomefactor.com. Catch up on the latest news from the East Bay market in their weekly Substack, published every Sunday. Go to thehomefactor.com to subscribe. If you'd like to reach out to me with suggestions for the show, that kind of thing, please text me at 415-446-8591. Catch you on the next podcast.